Hello and welcome to the August 15th, 2023 episode of Watching the Tape. In this week's video, I wanted to highlight how 1031 exchanges can be used to defer taxes forever. I'd imagine that many of you are at least familiar with 1031 exchanges, but here's a quick reminder nonetheless. A 1031 exchange is a tax deferral method where real estate investors can sell an investment property and reinvest the proceeds in another investment property to defer capital gains taxes. An example will be helpful here. So let's say you own a rental house. You bought it for $250,000 10 years ago. For various reasons, you are ready to move on and want to sell this property. The house is now worth $500,000. You would owe capital gains taxes and what are called depreciation recapture taxes on this sale. It might look like this. We'll fill in the pieces of this table as we go. First is the capital gains piece. And if you were to sell this property for $500,000 today, and your cost basis is $250,000, then the gain would be $250,000, taxed at a capital gains rate of 15% that we'll use in this example. That would give you a tax due of $37,500. Well, that's not the only piece. There's something called depreciation recapture as well. And let's say over the holding period of this property, you have depreciated $50,000 worth. Now that is taxed at your ordinary income tax rate up to 25%. So we'll use 25% in this example. So that's $12,500 right there. You add those two together and you get a total tax due of $50,000. You could, of course, avoid paying all these taxes if you were to instead roll the sale proceeds into another investment property using a 1031 exchange. Deferring taxes is nice, but you'll eventually have to pay the IRS, right? Not necessarily. And this is where your rental properties fit into a well thought out estate plan. That tax bill may never come due, and here's why. If your investment properties are held at the time of your passing or your spouse's passing, then the surviving spouse will benefit from what's called a step up in basis to the fair market value at the time of death. In Washington, it's actually referred to as a double step up in basis because this is a community property state. So we'll use Washington rules as we continue with the example. So again, a step up in basis refers to the adjustment of the cost basis of inherited assets to their fair market value at the time of the original owner's death. Let's go back to that rental house that's worth $500,000. Let's say you sell it and roll the proceeds into two different rental houses that over time appreciate to $1 million combined. Now remember, that cost basis from the original rental house carries over, and that was $250,000. So you'd be looking at a capital gain of $750,000 plus some depreciation recapture taxes. That would be a big tax bill upon the sale of these two properties if that's what you were to do. But that's not how it would work if one spouse were to die before this sale. Instead, the step up in basis allows the surviving spouse or children, if both spouses were to pass, to take the $1 million fair market value of those properties as the new cost basis. So the surviving spouse or children could sell those two properties for $1 million right away, and they would pay no taxes on that sale. A big part of estate planning is building and preserving wealth for the next generation. So using a tax deferral strategy like a 1031 exchange is something that you should be aware of if you're involved in real estate investments or are considering buying some. That's it for this week. If you found this video helpful or interesting and can think of anyone else who might benefit from the content, please share it. Thanks for watching. We'll see you in 2 weeks.